Everyone is celebrating Warren Buffett's retirement.
Today is Warren Buffett's last day as CEO of Berkshire Hathaway.
Warren Buffett steps down as CEO of Berkshire Hathaway.
Sitting down with you for the first time since the news last week that Kraft Heinz.
The legendary 60-year run, nearly 20% annual returns. He turned $100 into $5.5 million. But let me show you something the financial media is ignoring. For the last 5 years, Berkshire Hathaway has been losing to the S&P 500, and that $382 billion cash pile everyone thinks is genius, it actually cost shareholders $112 billion in missed gain. The man who never made mistakes might have made the biggest one of his career. Or is he about to be proven wrong when the market crashes? So here's the question that we need to answer. Is this cash pile America's greatest safety net for the next market crash? Or is it the most expensive mistake in investing history? Because right now, Greg Abel isn't just inheriting a legendary company. He's inheriting a $382 billion headache that's costing shareholders billions of dollars in opportunity cost every single quarter. Let's take a look at the numbers. On 3rd of May 2025, at Berkshire Hathaway's annual shareholder meeting in Omaha, Nebraska, Warren Buffett made a stunning announcement that he would step down as the CEO by end of year. The market's reaction was very immediate and brutal. Berkshire's Class A shares, which had peaked at more than $809,000 on 2nd of May 2025, dropped to 4.9% to less than $770,000 by market close, as reported by CNBC's market data. But this isn't just about billionaire shareholders. This matters to every American with a 401k, every pension fund, every index fund investor. Here's why Berkshire Hathaway is the 11th most valuable company in America. According to current market capitalization data from Bloomberg, Berkshire Hathaway employs over 350,000 Americans over insurance, railroads, utilities, and manufacturing. When Berkshire underperforms, it drags down retirement portfolios across the country. Let's run a simple calculation. According to data from CNBC and financial analysis firm Y-Charts, in 2025, Berkshire's Class B shares gained approximately 10.9% for the year. But what about the S&P 500? It was up by 16.4%. based on Federal Reserve's economic data. That's a 5.5 percentage point gap. Now let's translate that into real dollars for an average American investor. Let's consider a scenario of an average American investing $10,000 on 1st of January 2025. If $10,000 was invested in Berkshire Hathaway stock, the gain would be $1,090. However, if the same $10,000 would have been invested in S&P 500, the gain would be $1,640. In this case, the opportunity cost is $550 per $10,000 invested. For someone with $100,000 in the retirement account, that's $5,500 in missed gains in just 1 year. Over a decade with compounding, that difference could mean retiring a year earlier or a year later. This is the hidden cost of Buffett to Abel transition, and it actually gets even more worse. Warren Buffett took control of Berkshire Hathaway in 1965 when its Class A shares traded at $19. By December 31, 2025, those same shares closed at more than $754,000 according to data from the New York Stock Exchange. That's a gain of more than 5.5 million% over 60 years, as documented in Berkshire's 2024 annual report filed with the SEC. For comparison, the S&P 500 gained more than 39,000% during the same period, based on historical data from the Bureau of Economic Analysis. Buffett's compounded annual return of 19.9% nearly doubled the S&P's 10.4%. This made Warren Buffett not just rich but legendary. But here's what the financial media doesn't really want you to know. Warren Buffett has been actually losing his touch. Let's take a look at the last 5 years using data from Berkshire's SEC filings and S&P 500 index return. In 2020, Berkshire Hathaway's stock underperformed by 16 points comparison to S&P 500. In 2021, it matched. In 2022, Berkshire Hathaway outperformed by 22.1 points. In 2023, again Berkshire Hathaway stock underperformed by 10.5 points. In 2024, Berkshire Hathaway stock outperformed by 2.2 points. Similarly, in 2025, Berkshire was up 10.9%, whereas S&P 500 was up by 16.4%. So there was an underperformance of 5.5 points. Now, if we calculate the 5-year compounded annual returns, as you can see on the screen, the result of this is very clear. An investor in the S&P 500 would have made approximately 5% more than a Berkshire investor over these past 5 years. The question here is why? Why did this happen? And the answer actually brings us to the elephant in the room, or rather, I would say, the $382 billion in the room. According to Berkshire Hathaway's Form 10Q filing for Q3 2025, the company held $381.7 billion in cash and short-term US Treasury security. To put this into perspective, that is more than the GDP of countries like Ireland or Singapore. But here's the mechanism that most people miss. This isn't safe money sitting in the vault. Every dollar bleeding in cash, every dollar sitting in cash is bleeding value through opportunity cost. Now let me explain this to you with a very simple framework. When you invest, you're primarily faced with 3 different choices. As you can see on the screen, either you can hold cash, buy stocks, or buy undervalued companies. Warren Buffett has chosen the first option, and here is why. The US stock market's Shiller-Cape ratio stands at approximately 40 as of January 2026, according to data from Yale economist Robert Shiller. The historical average is 18. This means stocks are trading at roughly double the normal valuation. Warren Buffett has repeatedly stated in his shareholder letter that he won't overpay for assets. He is actually waiting for a correction. But while he waits, here's what shareholders are actually losing on: the opportunity cost calculation. Warren Buffett currently has a cash position of $381.7 billion. The treasury yield is 4.2% as per Federal Reserve data, and the S&P 500 historical return is 10.4% as per the Bureau of Economic Analysis data. And let's consider a time period of 5 years. If Warren Buffett had actually, what Warren Buffett actually earned on cash is $16 billion annually. Had the same money been invested in S&P 500, the money would have translated to $39.7 billion. So the annual opportunity cost over here roughly comes to $23.7 billion per year. Scale it to 5 years and it is $118.5 billion. That is so much amount of money just simply forgone in gain. That $118.5 billion could have been in shareholders' pockets. To put that into perspective, that's enough money to give away to every Berkshire employee, all 380,000 of them. A whopping $300,000 bonus. Now you understand why this isn't just about Warren Buffett's legacy. This is actually about whether the greatest capital allocator in the world actually made one of the worst capital allocation mistakes in the history. But wait, here's another possibility. What if Buffett knows something that we don't? Let's examine the historical evidence, because Buffett has been in this world much longer than any of us. 3 times in history, Buffett actually accumulated massive cash positions right before major market crashes. The 2008 financial crisis, wherein those investments actually generated tens of billions of dollars in return. The dot-com bubble in 1999-2000, where Berkshire outperformed the market significantly for the next decade. And as of today, 2026, Berkshire holds $381.7 billion in cash. According to Congressional Budget Office research, when valuations reach these levels, Forward 10-year returns historically average 2 to 4% annually, which is below the inflation and far below the historical norm. So the question becomes, is Buffett really a genius preparing for the inevitable market crash? Or is he an aging investor who missed the greatest tech rally in history? Here's what the data actually shows. If the market crashes 30% tomorrow, that $382 billion become the most valuable asset in America. Buffett could buy quality companies at 70 cents on the dollar. But if the market continues climbing another 20% over the next 2 years, as some Federal Reserve economists predict based on AI productivity gains, then Buffett's cash pile will have underperformed by an additional $76 billion. This is the actual gamble, and now it is Greg Abel's problem. Gregory Edward Abel, born on 1st June 1962 in Alberta, Canada, he is not a stock picker. He is not a folksy grandfather. According to his biography, documented by Britannica, Abel is a chartered accountant who spent his entire career in just one industry, energy. Abel started his career in 1984, and fast forward to January 2026, he becomes the CEO of Berkshire Hathaway. Under Abel's leadership, Berkshire Hathaway Energy grew from 500 employees to 24,000, managing billions in assets according to Federal Energy Regulatory Commission filings. But here's the strategic insight that most analysts are missing. Abel's timing is just perfect. According to Goldman Sachs research from May 2024, data centers will consume 8% of total US electricity by 2030, which is up from 3% in 2022. That's a 167% increase in 6 years. And who's the primary driver? Artificial intelligence. Each ChatGPT query uses approximately 10 times the energy of a Google search. Training a single large AI model like GPT-4 uses as much electricity as 100 American homes use in an entire year. And do you know who owns this entire infrastructure to power this AI revolution? It is none other than Berkshire Hathaway Energy. According to Federal Energy Regulatory Commission's data, Berkshire Hathaway Energy operates Mid-American Energy in Iowa, Illinois, South Dakota, and Nebraska, about 1.5 million customers. In Pacific Corp, 6 western states, about 2 million customers. NV Energy in Nevada, about 1.5 million customers. The total energy generating capacity is over 35,000 megawatts. One of America's largest energy producers. At May 2024 Berkshire shareholders meeting, Abel stated that electricity demand for Mid-American's Iowa utility alone is expected to double by mid-2030s due to AI data centers. He said, and I quote, "It took 100 years to build what we have today, and now it's going to double." But here's the picks and shovels play. While everyone else is positioned to buying Nvidia stock trading at a PE ratio of over 80, Abel is actually positioned to sell electricity that powers Nvidia chips. This is a classic Buffett strategy. Own the infrastructure, not the speculation, but executed very nicely and strategically for the AI age. So now let's answer the question that we posed right at the beginning of this video. Is the $382 billion cash pile America's greatest safety net or the most expensive mistake in American investing? The honest answer is we don't know yet, and that uncertainty is exactly what matters. The bigger picture here is that this marks the end of the greatest investing career in American history and the beginning of an uncertain new era. Buffett built Berkshire through financial engineering, buying undervalued assets and holding them forever. Abel will likely build through infrastructure dominance, that is positioning the company as the backbone of America's AI-powered future. Different strategies, different eras, different opportunities. The $382 billion isn't just a mistake, it's a loaded weapon. The question is whether Greg Abel will know when to actually pull the trigger. For now, the gamble continues. If this video helped you understand the biggest financial corporate transition in American business history, hit the subscribe button. I break down complex financial events affecting your money using data, calculations, and evidence, not just hype. This is US Finance Truths. Remember, in finance, the real power comes from understanding the numbers that everyone else ignores.